Today's lesson is going to be Chapter 13, Problem 13-4B. I'm sharing a screen with you now of Problem 13-04B. And what we're going to be doing in this particular problem is we're going to be working some journal entries. You're going to record your journal entries in the general journal. And then once we get them recorded, we're going to post them to our ledger accounts, which are represented by these T accounts. And once we're through posting to the T accounts, then we're going to prepare our financial statements for a corporation. The first financial statement that you'll prepare in this problem is going to be a retained earnings statement. And that's going to be a new statement for you. I don't think you've ever seen a retained earnings statement prepared before, so I think this will be something that'll be good for you. And then they're going to prepare part of the balance sheet, the stockholders' equity section of the balance sheet. And so that's all they're going to have you doing in this particular problem. They do not have you doing an income statement, which would be a part of the financial statements for a corporate form of business. So we're going to start with the journal entries. And on the first journal entry on January the 15th, it's telling you that they are going to pay cash dividends of 6 cents per share on the common stock. And it says the dividend had been properly recorded when declared on December 1st of the preceding fiscal year for the amount of $34,320. So because we are actually paying our cash dividends, what we have to do is we're going to have to record this transaction as if it were recorded as a liability on December the 1st. So there really should be two journal entries here, one on December the 1st and one on January the 15th. The entry on December the 1st would have been a debit to cash dividends and a credit to cash dividends payable for $34,320. This entry on January the 15th is a follow-up entry to the one that would have been recorded on December the 1st, which they did not ask you to do. So what we would be doing is we would be reducing the liability account, cash dividends payable, because we're actually paying the cash dividends on January the 15th. This payable account, again, was recorded last year at the beginning of December. On December the 1st, we originally had it credited to the cash dividends payable. So we're reducing this on January the 15th by the amount that we had recorded on December the 1st, which would have been the $34,320. We will credit our cash account for $34,320. And that's the first journal entry of this year, which is January the 15th. On March 15th, it says that we've sold all of the treasury stock, and we sold it for $6.75. So one of the ways that you can get the amount for that is you could look at the actual treasury stock account. You're going to be crediting it because you're selling the treasury stock. You'll remember that the treasury stock account is a contra stockholders' equity and has a normal debit balance. So the balance at January 1st was $288,000. If you sold all of it, you're going to sell the entire amount of the treasury stock of $288,000. But before we show this treasury stock as being credited, we would debit our cash. The cash would be debited for the number of treasury stock shares that were sold times 675. So you may have to go back and look at your beginning information to see if there was any treasury stock that they had. And in the information to begin with, they're telling you that the treasury stock, they had 48,000 shares of treasury stock, and that entire 48,000 shares is going to be sold. So I'll pull off my calculator here. We'll scroll down to my journal entry, and I'm going to take the number of shares of treasury stock that was given, 48,000. I'm going to multiply this 48,000 by the price that we sold the stock for, which was $6.75. So if you multiply the 48,000 times $6.78, that will give you, so sorry, it should have been $6.75. Again, you're going to start with your treasury stock shares, which is 48,000. We're going to multiply that by the amount that we sold the treasury stock for, which is $6.75. And that will give you 324,000 as the debit to the cash account. Our treasury stock would have been decreasing. To decrease treasury stock, which is a contra stockholders' equity account, you would have to credit it. You want to credit the treasury stock always for its cost. So again, we're going to pick up the number of shares of treasury stock that we had originally, which was 48,000. We would multiply it by its cost, which will give you 288,000. So just to check that out, it's 48,000 shares of treasury stock that was given times $6 per share, which is 288,000. Since we sold all of the treasury stock is going to be credited for the 288,000. Now the remaining credit, you can see we need a credit because our debits and credits are not balanced here. We'll go into what we call the paid-in capital from seller treasury stock. This paid-in capital from seller treasury stock is a stockholders' equity account and will increase on the credit side. It will increase for the difference between what we sold the treasury stock for and what we paid for it originally, its original cost. So 324,000 minus 288,000 will give you the plug figure of 36,000 that would be credited to the paid-in capital account from the sale of the treasury stock. Now you could have taking the difference between what you sold the treasury stock for, which was $6.75 per share, and what it cost you, which was $6. That would be 75 cents times 48,000 shares that were sold, and that would also give you the 36,000. So there's a couple of different ways you could have arrived at the 36,000, but I think it's easier just to add up your debits, subtract your credit, and put this in as a plug figure. On April the 13th, we have issued 200,000 shares of common stock for $8 per share. So we're going to debit our cash, because when we issue common stock, we're really selling the stock. We sold it for $8 a share. And since it was 200,000 shares that we sold, we would multiply that by $8, and that will give you 1,600,000 as the cash amount that we would have received. To increase cash, you would debit it for 1,600,000. We will credit our common stock account, but we're going to credit the common stock account for its par value. We know that we sold or issued 200,000 shares, so we're going to multiply those 200,000 shares by the par value of the common stock, which in this case is calling it a stated value. Sometimes they'll use stated value instead of par value, but it means the same thing. The stated value is just an amount that's been printed on the shares of stock. So that 200,000 shares that we issued would be multiplied by $5 as the stated value, and that will give you $1 million as the credit to the common stock. The difference between the amount that you sold the stock for and the stated value will be a paid-in capital account in excess of stated value on common stock. Notice the stated value changed from par value to stated value because that's what they're using in this problem. Par value and stated value is the same thing. The difference between these, the plug figure, is 600,000. And that's how you record the transaction for April the 13th. On June the 14th, we are declaring a stock dividend. There's a difference between a stock dividend and a cash dividend. A cash dividend, we're going to pay cash to our stockholders, but a stock dividend just means that instead of paying cash to the stockholders, we're going to give the stockholders some more shares of stock. And because that we're doing that, we're going to have to debit the stock dividends account for the amount of the common stock dividend. Dividends is similar to cash dividends in that it's got a normal debit balance. It is a stockholders' equity account. Actually, it belongs to retained earnings. It's sort of like the withdrawals for a proprietorship type of organization, but since this is a corporate form of business, we distribute our net income to our stockholders through either paying a cash dividend or, in this case, a stock dividend. We're giving the stockholders shares of stock instead of actually paying cash for this particular type of dividend. So our stock dividends account would have to be determined by determining 3% of the shares of stock that we have on hand as of June 14th. So if you'll bear with me for just a minute, I'm going to stop sharing this screen and I'm going to share with you an Excel spreadsheet that will show you how to calculate this 3% stock dividend. So I'm going to stop sharing this for just a second. I'm going to share my screen again, and I'm going to pick up Excel and share this with you. So now you should be seeing an Excel spreadsheet. And so what we're going to do is we're going to calculate the number of shares that would be in this common stock dividend, which happens on July the 16th. Before we can do that, we need to know what the beginning shares balance was. This is a given amount. In your information for the problem in Cengage, they started out with a beginning balance in common stock of 620,000 shares. We also had a beginning balance of treasury shares of 48,000. Notice I put a minus sign in front of the 48,000 because that 48,000 will take away from the shares that are outstanding for common stock. In other words, we never pay dividends on treasury stock, so we have to back out the treasury stock. So both of these were given to you as the beginning balances in those accounts. Subtract your treasury stock beginning balance from the beginning balance of your common stock, and then we're going to add to that balance the March 15th treasury stock that you sold. So in other words, you had treasury stock, then you sold it all, you put it back on the market, so it went in as a positive amount, because when you sell treasury stock, you're giving it back to the stockholders. Then on April the 13th, we issued some additional common stock shares of 200,000. So I created a subtotal which would have combined the amounts from B2 all the way to B5 together. You can see that formula when I click on this. You can see that I summed B2 through B5, and that gave me 820,000 shares as a subtotal after the April 13th transaction. When we take the July 16th transaction and record it, the dividend shares that we've got here, you have to determine those. And that's what we were doing in Cengage when we left off just a minute ago. So what I'm going to do is I'm going to show you that to determine this 24,600 dividends that are going to be in the stock dividend, you would have taken the 820,000 and multiplied it by 3% to get the amount of shares that are in the stock dividend. So it's important for you to note that there are 24,600 shares of common stock dividend that we're planning to distribute or give to our stockholders. So hold this thought, 24,600, you might want to write it down, is the amount of the common stock dividend shares that we're going to give out. So again, I'm going to stop sharing for just a second. I'm going to go back to Cengage. We're going to take this 24,600 and we're going to multiply that by the amount of the market price of the common stock that it was selling for, which happens to be $7.50. So I'm going to go back to Cengage and stop sharing this with you for a moment. And then I'm going to share with you Cengage again. So you should be able to see Cengage now. And what we're going to do is we're going to determine the dollar amount of the debit to the stock dividends. remember that we calculated the number of shares for the dividend at 24,600. So we're going to multiply that by the market price of the stock, which was $7.50, and that will give you the stock dividend dollar amount of $184,500. The next account that we're going to credit will be a new one that's created in this chapter, along with the other new accounts that we've talked about. And it's what we call the common stock dividend distributable. Because we are distributing common stock, we're going to create a common stock dividend distributable, which is an equity account. And we're going to create that for the total par value of the common stock. So I'm going to select my stock dividend distributable account. That's an equity account that would be credited because we're increasing the stocks that we are going to distribute in the future, in a future date. This is sort of like, it's kind of like a liability account, but they actually call it a stockholders' equity account because it would end up on the balance sheet in stockholders' equity at the end of the accounting period if there's a balance left in it. The amount of the stock dividend distributable you would need to calculate. You're going to calculate it by taking the number of shares of the common stock dividend that we calculated on our Excel spreadsheet. The number of shares were 24,600. And we're going to multiply that by the par value, or the stated value in this case, of the common stock. The stated value was $5. What that will give you is the total stated value of the stock dividend distributable, which is $123,000. And because there's a difference between the stated value and the market price per share, that difference is going to go into the paid-in capital account in excess of stated value on the common stock. So we're taking our debit of $184,500, and we're going to subtract $123,000 from that. And that'll leave you with $61,500. In the next journal entry, we're going to actually give out the stock shares that we said that we were going to do on June 14th. We're issuing the certificates of the dividends that were declared on June 14th. To do that, what we have to do is we have to reduce the stock dividend distributable account to take it off of our books for the amount of $123,000. We will credit our common stock account for $123,000. This is where we're actually giving our shareholders their share of common stock. We're distributing it to our common stockholders at $123,000. Then on October the 30th, we are going to purchase 50,000 shares of Treasury stock at $6 per share. Remember, Treasury stock is where we're buying back our own common stock. We're actually taking it off the market. We can do this so that we can distribute the Treasury stock to our employees as a bonus, or maybe we want to try to affect the market share of the common stock by stimulating the number of shares that are sold out on the market. So when we are buying Treasury stock, we're going to debit the Treasury stock account because it is a contra stockholders equity account. It's going to have a debit balance, and we're going to multiply the number of shares that we bought times $6. And that will tell us that we have paid $300,000 for that Treasury stock. Our cash account would be decreased by $300,000 to decrease cash you would credit. In the next transaction, which is December the 30th, we have declared an 8-cent per share dividend on common stock. So we're declaring a cash dividend this time, but we need to know the number of shares of common stock that we have outstanding as of December 30th. So before we can do this journal entry here, before we can fill the amounts in, we need to know exactly how many shares of stock that we have on hand. So again, I'm going to stop sharing this screen with you, and I'm going to share with you the Excel spreadsheet, and we're going to calculate the number of shares that we have available for the common stock at this particular point in time. So we're referring back to the Excel spreadsheet. You should be able to see that right now. You'll remember that the last transaction that we did on July 16th also involved a dividend. And that dividend amount that we calculated was $24,600. So to the subtotal, we're going to add the common shares dividends that we distributed as of July the 16th. And then we're going to back away our Treasury stock shares that we purchased. And that will give us a total shares of common stock. This amount right here, the 794,600, you need to be able to calculate the amount of your cash dividends. So 794,600 is important. Write that down in your notes, and then we're going to stop sharing this. I'm going to go back to Cengage, and we're going to resume our journal entries. So on December the 30th, we're declaring an 8-cent per share dividend on stock. This is a cash dividend. So we're going to debit cash dividends. Cash dividends are increasing. We've got to determine the amount of the debit. Remember from your Excel spreadsheet, we have the number of shares of our common stock that we have outstanding as of this date, and the number of shares of common stock as of that date was 794,600. So I'm going to take 794,600. This comes from our Excel spreadsheet. I'm going to multiply that by 8-cent per share. And that will give me the amount of my cash dividends, which is $63,500. $568. We would credit then our cash account, excuse me, not cash, that doesn't belong there, but the cash dividends payable, because we're declaring this dividend. Doesn't mean we paid it yet. We're just saying that we owe it. It takes some time between the date that we declare the dividend to get our records together so that we will be able to pay that cash dividend in the future. They don't tell us what the payment date is in this particular problem. So we're just showing that we have declared the dividends here, that we owe it to our stockholders at $63,568. All right, and then the next thing that they have us doing is they have us showing that we are going to be doing a closing entry for the dividends accounts, and we're going to close those two retained earnings. I don't feel like that's in the proper order yet. What they did, unfortunately, in this particular problem is they had you doing in requirement number 2, journalizing the entries, which really should have been, I think, requirement number 1. And then we would post these journal entries to the ledger accounts that we've got available. So these are the normal journal entries that we might incur throughout the accounting period. We're not at the closing process yet. So what I want to do is I want to post the normal journal entries, the day-to-day journal entries up until the end of the accounting period to these ledger accounts. So I'm going to start with my January 15th date. In my journal, I debited cash dividends payable for $34,320. In your ledger, you would have had a cash dividends payable account. And again, I don't know why they didn't give you all of the ledger accounts here. So there's nothing to post to that particular journal entry. They didn't give us a cash account either to post to. And you know that in the ledger, we would certainly have a cash account. But this journal entry should have been posted to our ledger accounts before we could prepare our financial statements. Again, we don't have a cash account to post to, but we do have a treasury stock account to post to. So I'm going to pick up that $288,000 and I'm going to post that to the treasury stock over here as a credit. And you'll want to put in the date of that transaction. The date of that transaction happened on March the 15th. So let's put our date in on March the 15th. And then we will have posted to the treasury stock transaction the credit of $288,000. Remember, we sold all of that treasury stock on the date of March 15th. In addition to that, we would have to credit the paid-in capital from sale of treasury stock for $36,000. So I'm going to go to my paid-in capital from sale of treasury stock. And on March the 15th, I'm going to record the amount that I credited to that account, which was $36,000. And so I am posting to my ledger accounts. On the next transaction, there is no cash account to post to, but there is common stock. Notice we credited common stock for $1 million. So our common stock account would be credited for $1 million. and I'm gonna have to look to see what date that was. The common stock account was credited for $1 million on April the 13th. And then I would have to credit my paid-in capital in excess of stated value on the common stock for $600,000. So I'm going to post that as of April the 13th, $600,000. To the paid-in capital in excess of stated value on the common stock. The next transaction that I need to post to is June the 14th. I'm going to post to my stock dividends account. 184,500 would be debited to stock dividends on June the 14th. And again, that amount on June the 14th was 184,500. And that was credited to the stock dividends account. My stock dividends distributable account would be credited for 123,000. And then I would have credited my paid-in capital in excess of stated value on the common stock for 61,500. Just bear with me just a second. Kind of lost my place here. Okay, I was on June the 14th transaction, and I was posting to the paid-in capital in excess of stated value on the common stock. And that amount was 61,500. Then I'm ready to do my July 16th transaction, which would be a debit to the common stock dividend distributable for 123,000. And again, that date was July the 16th. And then we would have credited the common stock account for the amount that we gave, which was 123,000. The common stock account would be credited on July the 16th for 123,000. And then we move on to October 30th. We would debit our treasury stock on October 30th for $300,000. And our cash would have been credited. We don't have a cash account for a ledger account there. So we move on to the December 30th transaction. And on December 30th, we've got a debit to cash dividends for $63,568. And we have a credit to cash dividends payable. And I don't think they put the cash dividends payable on this particular ledger account, but that you would have credited it in the real world to that ledger account. The next thing that I probably would do is I would go ahead and balance the ledger accounts that I could balance at this particular time. And so I'm going to start with the common stock, and it has a beginning balance of $3,100,000. We're going to add to it the $1 million. And we're going to add to that $123,000. All of these were credits to this account. So the balance of this account is $4,223,000. My paid-in capital just has credits to it. You would combine all these together, $1,240,000 plus $600,000 plus $61,500, and the balance would be $1,901,500. We're not ready to balance the retained earnings just yet. And we're not ready to balance the, well, yeah, we could go ahead and balance the treasury stock. So these two canceled it out. So what we have is a remaining balance of $300,000 for the treasury stock. And this is the balance in the paid-in capital. There's no balance in the stock dividend distributable. All right. And so these are the balances that we would bring forward to our financial statements. You should prepare an income statement first, but in this particular problem, they didn't have you doing that. I'm going to come back to this closing entry because technically you wouldn't do closing entries until you were through with your financial statements. Closing entries come after the financial statements have been prepared. So we're going to start with the retained earnings statement here. And in the directions, they are telling you to assume that Navgo Enterprises had net income for the year of $775,000. So instead of you having to prepare an income statement, they gave you the net income amount. You have to have the net income amount to be able to prepare the retained earnings statement properly. Retained earnings is exactly what it says it is. It's the amount of net income that you've kept in the business. Notice it's prepared for a time period too, just like if you were preparing the statement of stockholders' equity, or excuse me, if you were preparing the statement of owner's equity, you would be doing that for a time period. Since this is a corporation, the retained earnings statement is prepared for a time period. We're going to start with the beginning retained earnings balance. This would start at the beginning of the year. Since this is a calendar year ending, we start at January 1st and we look for the beginning balance. The only way you'll know what that beginning balance is you ought to be able to look at your ledger account to find that beginning balance. And you see they've got it written down there for you. And it's also, you can find it up here as the given amount that they gave to you. But the beginning balance is $4,875,000. To this, we have to add net income. Net income adds to the retained earnings balance. The net income would come from the income statement. We didn't have to prepare it, but it was a given amount of $775,000. Then we're going to record our dividend accounts. You'll remember we had two types of dividends. We had cash dividends. And look at your ledger. Look at your cash dividends. The balance in the cash dividends account is $63,568. And we also had stock dividends. Our stock dividends account had a balance of $184,500. The next step is to combine the net income, the cash dividends, and the stock dividends. The stock dividends and cash dividends will decrease the amount of net income. So net income is a positive amount. The dividends will take away from the net income. Those are dividends that you paid out, so we're going to subtract those from the net income. And we're going to subtract out our stock dividends. And that will leave us with an increase in our retained earnings because the net income was more than the dividends that we paid out. We would have had an increase in our retained earnings for the amount of $526,932. It might be a good idea to check your math here, and you can see that we're okay so far. The last thing you want to do is show the ending retained earnings balance. You're going to take the beginning retained earnings and add the increase in retained earnings for this period. That will give you the ending retained earnings balance as of December 31st. So we're going to add the increase in retained earnings to the beginning balance. And that will give us total retained earnings of $5,401,932. And again, it'd be a good idea to check your work here. Once we're through with the retained earnings statement, then we would prepare the balance sheet. They only gave you the stockholders' equity portion of the balance sheet. This is what's new to you in this chapter. Assets and liabilities would also be recorded on the balance sheet, but instead of owner's equity, we would be recording stockholders' equity. The balance sheet is prepared for 1 day and 1 day only. And the stockholders' equity consists of all of your paid-in capital accounts, which are your stock accounts, as well as your paid-in capital in excess of stated value, or paid-in capital in excess of treasury stock cost. But the first thing that we need to put in here is our common stock. Notice that on the balance sheet, the common stock has stated value, which does not change. The number of shares authorized will not change. That's how much they had available to sell when they started the corporation. But notice the shares issued are 844,600. This will balance up to that Excel spreadsheet that we prepared earlier. The common stock dollar amount is going to come from the ledger account for common stock. Common stock had a balance of 4,223,000. And that's what goes in as the dollar amount. Again, this is coming from your ledger accounts. So the common stock balance, this amount was written in first. Also on your stockholders' equity, you'll pick up your paid-in capital in excess of stated value on the common stock. The amount of that balance was 1,901,500. And that was the additional paid-in capital in excess of stated value. Also, we would pick up our paid-in capital from the sale of treasury stock. And that's going to go on this line right here. So this line right here is a subtotal. We're going to total the paid-in capital on the common stock. We're going to add these two together. So the common stock of 4,223,000 is going to be added to the 1,901,500. And that's going to give you a subtotal of 6,124,500. And I'm going to check my math just to make sure I'm okay there, and I am. And then we're going to look at what the paid-in capital was from the sale of treasury stock. The paid-in capital from the sale of treasury stock was $36,000. And then they want you to total the paid-in capital, which is combining both of these together. So 36,000 would be added to the 6,124,500. That would give us 6,160,500. And it's a good idea to check to make sure your math is correct at this point in time. So that's your total paid-in capital. What you have to do is you have to figure your total paid-in capital first, and then we're going to add the retained earnings account to this. The retained earnings would come from the ending balance on our retained earnings sheet that we previously did. The retained earnings ending balance is $5,401,932. And then we're going to total our paid-in capital plus our retained earnings. And that's going to give us 11,562,432. And that's a 2 there. I know it's not showing up, but it's what we've got on our calculator there. That's the total of the retained earnings balance and the total paid-in capital. It's really like a subtotal here. Then the last thing that we're going to record is our treasury stock. Remember that treasury stock is a contra stockholders' equity account and really reduces the amount of our stockholders' equity. The balance of the treasury stock account was $300,000, and that $300,000 has to be recorded here because treasury stock is a contra stock account. It is deducted from the total that you got earlier. So we're going to subtract 300,000 of treasury stock from that previous total, and that's going to leave us with a total stockholders' equity of 11,262,432. And so that's your stockholders' equity section of the balance sheet. Again, that last 2 doesn't show up there, but this is the total right here. So once you have prepared your financial statements, then you have a right to close out accounts. You would close out all your revenues, all your expense accounts, and we close out our dividends because these are temporary accounts for us. We close the dividends account to the retained earnings. And so what we're going to do is we're going to debit our retained earnings for the total of the dividends account. We're going to close out our stock dividends first. So to close out the stock dividends, I'm going to go up here. To close it out, we would have to, on December 31st, make that closing entry. We'll close it out for the debit amount here of $184,500. We're forcing this account to equal 0. And the only way we can do that is to credit this account. So our stock dividends account is going to be credited for $184,500. We would also have to close out our cash dividends account. The cash dividends account had a debit balance of $63,568, which we'll have to credit that account to reduce it to zero. So again, that was $63,568. Our debit is to retained earnings for the total of our dividends. So the total credits is $248,068. I'm going to check my work just to make sure my math is correct here. And that amount would be debited to the retained earnings account. So my retained earnings would be debited on December 31st for $248,068. We also have to record the fact that net income will add to retained earnings. So the net income would have been calculated on December 31st. The net income was given to us at $775,000. Net income adds to our retained earnings. And so we can now balance our retained earnings account. The credit side is the increase side. So we'll start with our beginning retained earnings balance. We'll add to it our net income of $775,000. And then we'll subtract out our dividends that have reduced the retained earnings. Start again. $4,875,000. My beginning credit balance plus $775,000 minus the debit to retained earnings for dividends of $248,068. The balance is $5,401,932. I want you to notice this balance has to be equal to the retained earnings balance at the end of the period. They should be the same, and they are. So this is the entire problem that they're having you to do of 13-04B. So we'll stop sharing this, and I will see you again next time.